Hey everyone, thanks for joining today. I'm Alice Leung and I work for Brick and Mortar Ventures. I'm super honored to be here and excited to talk to you about demystifying the venture capital world for AEC entrepreneurs. So I wanted to start off this presentation just to give you a little bit of context to tell you a little bit about Brick and Mortar Ventures. We are a built world focused fund investing in early stage startups that are solving pain points in the what we call the construction process. So that process starts with design through pre-construction, construction, handover, commissioning, and operations and maintenance. And we invest in technologies that work across all market verticals. So from single family residential to commercial real estate to oil and gas, your hospitals, data centers, mining. Always half jokingly say when we start building stuff in outer space, we'd love to invest in space construction tech. And this is our team. We're a small team of five. All five of us are somehow related to the construction process. And four out of the five of us have direct AEC operations experience. So you can kind of see just based on some of the logos underneath our names. Like I mentioned, I'm Alice, actually the newest member of the brick and mortar team. I've been with the firm for a little bit over a year now. And I wanted to introduce myself for a little bit to provide some additional context as to why I'm related to construction. So before joining brick and mortar, I worked for DPR Construction. I started my career as a project engineer. I was out on the construction sites managing scopes of work. Early on in my career, got pulled into managing 3D model coordination, and that was kind of when I fell in love with BIM and VDC. So on my first project, it was a large hospital project. Got to build the building virtually, and then find all the problems, and then build it physically. Where I think the construction process went pretty smoothly. So worked on 2 hospital projects here in the San Francisco Bay Area. Was also part of the innovation group at DPR, more on a voluntary basis, where I got to meet with a lot of early stage startups at the time, do some pilot projects with technologies such as drones and some of the technologies that were getting developed around point cloud data. And really enjoyed working with new technologies at the time and helping implement those on site. So I really found a lot of enjoyment out of working with a lot of the folks out in the field and understanding what were some of the technologies that they were interested in and what types of technologies were actually easy enough and relevant for them to use. So it was very much a focus on product and user interface when working with technologies and understanding how do we get more people access to the information in the 3D models that we were working on. So like I mentioned, was working here in the San Francisco Bay Area, and then relocated to Singapore as part of the Southeast Asia team. There was just 2 of us at the time, so helped a little bit in setting up that Southeast Asia office with awesome colleague Joe Yao. And got to work on some data center projects overseas, did some consulting work for clients around BIM for FM, and really got to see, the economic drivers for technology adoption around Southeast Asia. Had a blast, but it was time to relocate back to the US, kind of given that I was there for 2.5 years, and worked on a neurosciences building with DPR Construction here in the San Francisco Bay Area. Really enjoyed the construction side of things, but also saw an opportunity to go work with construction technology startups, and I kind of saw that the world was changing, and we were seeing a lot more technology startups pop up around the time, and got the opportunity to join the brick and mortar team, and really couldn't hesitate. So like I mentioned, been with the firm for a little bit over a year now, and the whole world of venture capital was new to me. And luckily, I have an awesome team, and I was able to learn a lot very quickly about what is venture capital, how do we work with startups, what are some of the different types of startup business models, how you set that up, and yeah, given some of the construction operations experience, I think we're able to work a lot closer with a lot of the startups that we talk to, as well as, other investors in the space, and helping share, our personal pain points that we've lived through working in the operation side, and also helping share, some of our industry insight. So also wanted to tell you a little bit about our limited partners. So these are the investors in our fund, and later on in the presentation, I'll kind of help explain, how they fit into the overall picture. But our first fund is backed fully by corporate strategics, and they're all, large players in the space. And I'm sure y'all are very familiar with them working in the industry. And these are some of the companies that we've invested in. So these are our portfolio companies. They're kind of working all over the place. So you could see some of them are hardware, some of them are software, some are doing 3D printing, some are, creating very intricate sensors to help track stuff better. And it's really just a really wide range of technologies that we've had the opportunity to invest in. And these are awesome startups for us to work with. So if you're interested in any of these, feel free to reach out, and I would be happy to help tell you a little bit more about them and facilitate some introductions if you're interested in chatting with them and learning more about their journey and what they're working on. So I like thinking about this. This is, one of those questions where it's like, why is brick and mortar ventures here? And I think you can, because we're so focused on the industry, we're one in, there's just a handful of venture capital firms that are focusing just on the built world. So I think this is always a fun question. Why are we here? So I'm sure you guys have all seen this. It's a very famous and popular McKinsey graphic from some of their reports. And, over the last, I think, 5 years, I've seen this in almost every presentation, either from the startup. I think from the industry side, we've seen this a couple of times as well. And it's definitely not getting old anytime soon. So if you look down at the bottom, the construction industry is the second least digitized industry of all the industries that McKinsey tracks. So I think this has always been, one of those things that's been hanging on our industry. And, the reason behind that, it's not necessarily that, construction people are lazy or construction people don't know technology. I think, you could look around and you could see a lot of people from industry that have been, working on either building new technologies or trying to bring technologies into the space. But really, I think one thing that we like to emphasize to people who are not familiar with the construction space is that, it's a very difficult environment to build technology for. So if you look at the left side of the screen, this is a graphic of, how construction was done many years ago and how construction is done today. And I think, it was just recently when we are able to build technology for construction, or at least for greenfield projects, because if you look at any of the projects that you've worked on, usually we are the first people there on site. So the contractors, or the architects or the owners, when you're doing site selection, usually it's empty and there's no infrastructure, there's no water, there's no power. Sometimes it's in the middle of nowhere. You don't have GPS, you don't have cell service. So really you're going into this place that has nothing. And we are the first people to bring the infrastructure there. So when you're thinking about technology, it's like, if you don't have cell service, how are you even connected to the internet? Computers are basically useless at that point, right? So we classify the construction environment as a GPS denied metallic and dynamic environment. So it's metallic because when you're going on in construction, you have large, forklifts or other large pieces of equipment moving around, and metallic objects affect signals for a lot of technologies. And it's dynamic because, on a day-to-day basis, the construction site is changing, walls are going up, you're pouring concrete. So it is a pretty challenging environment to build stuff for. And, it wasn't until recently when there have been a lot of, innovations in aerospace and military and defense, where, some of those technologies are now at a price point that makes sense for construction. And from a, smart device perspective, it wasn't until probably, frankly, it's when iPhones were invented, where it was a phone, basically a computer in your pocket that was had an easy enough interface for a lot of people to be able to utilize. So I think the timing of this all is it wasn't until recently when we were able to actually bring a lot of technologies into the field. And that leads me to, what is venture capital? So, if you look back over the last 20 or so years with, the dot-com boom and all that type of stuff, a lot of the funding that has gone into really high-risk businesses have come from venture capital. So there's, if you're looking at starting a business, there's definitely a lot of different types of funding options for you. And venture capital is just one of them. And looking at venture capital, I like to start maybe on the right-hand side of things. It's not the best type of funding for all types of businesses. So usually when we're evaluating startups to invest in, we like to question, is venture capital actually the right type of funding for this type of business? And for a lot of the typical types of startups that require venture capital are those that will not be generating near-term cash flow. So a lot of the times for venture-backed startups, for the first couple of years of that startup's life, they are not super focused on profitability. It's more of a focus on growth and scale, and getting that new idea out there and getting a lot of people utilizing that product. And if you look at a lot of the big companies that have recently done IPOs, a lot of them are actually not profitable. And that is the focus of VC is well, not so much anymore. I would take back what I said. There's more of a focus on profitability now, but the main focus of this type of capital were for high growth, high scale businesses. And given that a lot of these companies are not generating near-term cash flow, it's a risky business for banks to fund. Typically when banks do their evaluation, they want to know exactly when is this business going to start being profitable and when they can return, the loans that they've taken out against me. So a lot of the times, venture capital backed businesses are too risky for banks to help provide loans to. And for venture capital backed startups, there's typically going to be some conversation around exit strategy. So we invest in companies that are looking to IPO, so take to the public markets, or get acquired within a 6 to 8 year time frame. And that's because a lot of venture capital funds have a 10-year fund life. And within that fund life, we need to return the capital that that was invested into our fund by our limited partners. And I'll talk a little bit about that in upcoming. So what is venture capital? It's a type of equity financing. So for investors to give money to early stage startups, the startup will then give away part of that company. So they'll give away a percentage of that company. So contrast that with, some of the, actually almost all architecture and engineering and construction firms, I think, were started kind of organically. And a lot of those companies started with, a small business, grew over time. So if you look at a company like Bechtel, they've been around for over 100 years, started, as a fairly small business, and now is a, global player. They didn't take any venture capital dollars, right? So I think a lot of AEC businesses are not familiar with the idea of venture capital dollars. And frankly, it's because that's typically not the type of business that VCs would invest in. But construction tech companies, on the other hand, those are the types of companies that we invest in. So just to give you some context, I mentioned limited partners or LPs. So if you look at the left-hand side, just a generic example of how the money flows is, the limited partners will invest in a venture capital firm, and they may have multiple funds. And that venture capital firm then takes those funds and invests them into startup companies. And once the startup receives venture capital dollars from a certain VC, they are then called a portfolio company. So I had mentioned, and I showed a slide on all of our portfolio companies. Those are all the startups that we have invested in. So just to give you a real world example, Look on the right-hand side of the screen. This is brick and mortar ventures. Not all our LPs are shown, but as an example, Obayashi, United Rentals, and Hilti, they are LPs that have invested in our fund. We have the kind of discretion of where to invest those funds. They have trusted us to make those decisions. So we have invested in companies like Branch Manufacton, Connect Homes, and Wynomia. And I think understanding the VC firm structure is pretty important, especially if you're looking to raise money from venture capital firms, just to get an understanding of, how does the people that are investing in you make money? And I think this is the parallel to construction is, at DPR, when I was on the general contractor side, we always took the time to understand, how do our clients make money? What is our client's business? And that helped us be better partners in that sense. So I think the same goes with, VCs and startups. Understanding how the VCs make money, help the startup founder when they're raising money, understand sort of what's in it for them, and just understand the whole economics of, this whole space. So typically, how VCs make money is they charge a 2% annual management fee to their limited partners, because VCs are kind of like a fund manager, and they get 20% carry fee or carried interest. So what that means is the VC basically gets 20% of the overall profits that the fund returns. And as I mentioned, the fund life is 10 years. So within that 10-year time frame, the venture capital firm needs to invest in all of the startups and have the startups exit some way and return the funds to the limited partners. So just as an example, let's take a $100 million fund. Roughly 20% of that $100 million fund will go to management fee. So the 2% fee charged annually is roughly 20%. So what's left is 80% of that fund gets to go into the investment. So if you're looking at raising venture capital, it's good to understand, where the fund is in terms of their overall fund life, like whether or not, they're still deploying capital, because there are going to be a couple of different dynamics that come into play. And I would be happy to elaborate on any of that. I know this is going to be a short presentation, so happy to answer any questions as well. So the example was $100 million fund. And let's just say at the end of the fund life, we invested in 20 portfolio companies. Some exited, some got acquired, and frankly, a majority of them actually disappear. So, I think the statistic is like 9 out of 10 startups don't make it. So, as our example goes, out of those 20 companies, let's say the total returns is $350 million. So in the calculation, how much money do we return to our LPs versus how much money is left over for profits for the VC? So the return for the LPs is $300 million. If you take the $100 million original investment, that always gets returned back to the LPs, and you subtract that from the 350, you have 250 million. So like I mentioned, 20% carry fee goes to the VC. So 80% of the profits go back to the LP. So 80% of the 250 million is 200 million. So 100 million plus 200 million is 300 million, and that goes back to the LPs. Of course, this is simplifying, the numbers are not always round. And then that 20% of the 250 million is $50 million, and that goes to the venture capital firm. So that's how they make money. So of course, the incentive is to make sure that all of the companies that you invest in are very successful, because that will create a greater return for the LPs as well as the VC. And typically within those profits, there is some type of incentive for the team members working at that venture capital firm. And because we're in the AEC space, and because it's a little bit untraditional and it's a new area of focus from an investment perspective, I wanted to tell you a little bit about institutional venture capital and corporate venture capital. So there are two types of, venture capital options in the AEC space. So we are institutional venture capital. So these are the things that you'll get from an institutional VC. So capital, advice, hiring. We evaluate companies a little bit differently from a CVC. So we would look at things like total addressable market, founders, what are their stories, scalability of a business, and really returns. So we are a returns driven fund, and we aim for at least 10x return. That's always the goal. Of course, you're always looking for those unicorns. So unicorns are companies valued at at least $1 billion. So we always look for those types of companies that will make it big. Like the Aconex or PlanGrid, those were very successful companies in the construction technology space. So just wanted to emphasize we are financially driven. So the difference for the CVCs, they can kind of offer, similar, they can offer capital as well as advice. And something huge that they can offer are pilot projects and access to users. So because, they're usually consists of folks from innovation, folks from corporate finance, or whatever that mix is for the CVC, a lot of the times they work really closely with a lot of the operations groups within the large company. So for startups working with CVCs, they get access to a lot of feedback, or they get access to pilot projects, which is key to growth. And their evaluation criteria tends to be a little different. This is pretty generic, but they may look at, what is the impact of this new type of technology on the business? So they would get a lot of strategic value out of looking at startups. So whether it's, internal productivity gains or efficiency gains on some of their processes, that's all strategic value for the large company that the CVC is part of. They would also look at scalability as well. So if you're looking at, if I did this pilot project in this one region, how easy would it be for me to scale it across that whole region and or across the US if, I'm a big company that works nationally. They would also look at, the stability of a startup. It's a huge risk to work with a startup. And, what if in 2 years' time they end up no longer being able to raise funding and they have to disappear? So I think, that is something that large companies will look at when they're evaluating whether or not they want to work with a startup. And another interesting thing is, a lot of large companies will look at customer support because, it will be very difficult if, the CVC team had to make sure that a lot of these startups were implemented properly on across the region. So I've noticed that this is a thing that large companies will look at because they can't have, their IT team or maybe their BIM managers go out and support all of these new startups. So the startups themselves have to have some type of customer success or customer support team. And for the CVC, from a returns perspective, varies across the board. Some also look for financial returns. Some are more focused on, that strategic value. So I would say overall, the CVCs are strategically driven when it comes to investing in startups. And I like to just put this out there. Brick and mortar ventures, we kind of feel like we're a little bit in between because we're so industry focused and we work with so many industry players that though we are financially driven, we are from industry and we kind of had, before coming to brick and mortar ventures, this kind of intrinsic passion to help innovate in the space. And just one example of a corporate venture capital firm that startups like working with is Haskell has a group called Disrupt Tech, and that's kind of, I would say, the innovation / CVC arm of Haskell, and they've not only invested in a company like Blocks, but they also work with early stage startups to do pilots such as Ghost Robotics. So you can see on the bottom right hand side of the screen, it's a 4-legged robot that they can basically have autonomously go around the job site to either check for quality, capture photos, or whatever it is that they want. And just I wanted to throw up some headlines in there since we're talking about venture capital. Just in this last year or so, we've definitely seen a lot more interest in construction technology from both the investing side as well as the adoption side. So I think especially with COVID-19 and the need to digitize a lot of workflows, we've definitely seen, a lot more interest in new construction tech. These are some of the trends. They're anecdotal. I don't have really good data on this, but this is through conversations within our own team as well as other investors in the space. We are seeing increased interest in construction technology from generalist venture capital firms. So these are companies like Menlo Ventures and Greylock Partners who have, they've invested in the Ubers, Instagrams, Googles, Facebooks, and all of these other large tech startups. We're now seeing those types of VCs who don't know anything about construction now get interested in the construction technology space. We're also seeing more limited partner interest, so more people who wanting to invest in venture capital firms to deploy capital to startups. And we're also seeing AECO companies standing up CVC or working with the innovation group to either invest in and or work with startups. So some examples here include WND Ventures, Disrupt Tech that I mentioned, and Suffolk Capital. So this is all really great. It's great to see people kind of putting money where their mouth is with putting money to work in new technologies for our industry. And that's it for my presentation. I will be around for questions. If you want to ask anything, I am happy to help. I'm happy to elaborate on my journey, happy to talk about the world of venture capital or the world of finance, happy to talk about new solutions that you're looking for. I think in my role, I see almost 100% of all of the construction technology related startups. So if you're looking for a particular solution, I would love to chat with you. I could probably give you a couple of companies to go look at. And yeah, I'll be here for any questions. Thank you.